Heidi Richardson, the market is betting that the Fed will hike rates in December. We've already seen the 10-year Treasury move from 2% to 2.3%. So should investors fight the Fed or not?
No, I don't think they should fight the Fed. I think they should embrace it. I think when the Fed raises interest rates, it creates risks in some investments, but also creates some great opportunities in both fixed income and equities.
All right, and you see opportunities in the IYW, which is the US Technology ETF. It's up over 4% this year. We got some great earnings in the third quarter from the big technology players. I guess you think this will continue, right?
Yeah, so when you think about it, if the Fed raises interest rates, any sector that's loaded up with debt is going to be very, very vulnerable. When you look at tech, it's one of the only sectors that's flush with cash. So if the Fed increases interest rates, it's not going to impact them in terms of their bottom line nearly as much. They have lots of cash to continue with shareholder-friendly activities like increasing dividends, doing share buybacks, continuing with merger and acquisition activity. So I think tech would be geared for growth.
All right, and I guess if you get a Fed rate hike, it also helps the banks, right? Mm-hmm. And that's perhaps why you like the IYG, which is a financial ETF. Now, one thing about third quarter earnings is that some of the big banks did well, but the investment banks, a little bit more troublesome. So why don't you talk about that?
Yeah, so I think if you look at something like IYG, it's loaded up with a lot of banks in there, but a lot of regional banks as well. And I think that they're poised for growth because if you look at the Fed raising interest rates, they can charge more on their loans, but they're not going to do an equivalent increase for the depositor. So the net interest margin generally improves.
All right, and you also like Europe and Japan. I guess, once again, their currencies are going to be weak. They'll be able to export more because our currency is going to get stronger with that Fed rate hike, right?
Yeah, I mean, let's start with Europe. If we look at Europe, I think there's a couple of things. First of all, with the weak currency, that's a tailwind for big exporters like Germany, as an example. So I think that's a real positive. But when you're looking at the Bund at, potentially locking up your money at 60 basis points for 10 years, and you can go into Eurozone equity and get a dividend yield for 3.5%, you're starting to see that shift of investors embracing the equities in Europe. If we switch over to Japan, looking at Japan, they've had some unprecedented stimulus, similar to what's happening in Europe, likely to continue. I think there's a lot of real positives there. Japan Post just had their IPO. That was a real favorite for the markets, and I think it's drawing a lot more attention to Japanese equities.
All right, and then finally, with all this going on in the equity market, what do I do about my bonds?
Yeah, well, I think there's a couple of things. Most investors realize that when interest rates go up, the price of bonds go down, right? But there's ways to mitigate some of that risk, adding some short credit exposure as an example. So trying to think about getting something that's going to yield a little bit more to help offset any of the potential price decline. So I think it's really two things. It's adding some credit, it's looking at shortening up some duration, and then looking at some things like floating rate notes that might be able to help in terms of rising with the interest rates.
All right, well, thanks a lot, Heidi.
My pleasure.
Thank you for watching The Street.